Hey everyone, thanks for joining us today. We have an extra special guest, Ryan Bishop. And Ryan and I connected because he is a financial planner who truly understands the power of a reverse mortgage. Just knowing him over the years and hearing him speak, I thought you guys should hear him speak because it's awesome. So, welcome, Ryan. Thank you for joining us today.
All right. Well, thank you for having me, Christina. Glad to be here.
Yeah, thank you. So, if you could just tell the audience a little bit about yourself and your practice, and then we'll go from
Sure.
there.
All right. Yeah. Well, my name is Ryan Bishop, like you said, and I'm based out of Bellevue, Washington, sort of a suburb of Seattle, great up in the Pacific Northwest. And I've been in the industry about 8 years now, and been kind of a crazy journey and how I even got into the industry in the first place. But we'll maybe save that for another time. But yeah, I just fell in love with this industry and being able to help people with one of the most important facets of their life, which is their lifetime savings. And so, we're very outside the box as a firm in general. We're very focused on tax advantaged planning and retirement income planning, and we try to teach people how they can position themselves to retire at or near the 0% tax bracket. Because I think you would agree that if I was to ask, do you think taxes are going up in the next 5, 10, 20 years, you'd probably say yes, absolutely, and they have to, just the way that the country is from a fiscal condition right now. But you know that's important, and if you can understand how you can do that using all types of different vehicles and strategies to get there, it is 100% possible that you could have an end date where you could no longer have to pay taxes ever again.
I'm sure some of our audience members are very interested in that. This session is a little bit on the retirement income piece, though. So
Mhm.
I've heard you speak about this many times, and the conventional thing that reverse mortgage people hear is, "Hey, talk to your financial planner before you do a reverse mortgage." And in the industry, it's a little bit of a joke because most financial planners don't understand a reverse mortgage well enough to actually advise on it. And when I heard you first speak, you do. And not only do you understand it well enough to advise on it, you understand some amazing strategies about it. And so I wanted to see if you could kind of share with our audience some of the strategies that you know about and you incorporate for your practice.
Sure. Yeah, happy to. The industry as a whole, from a general perspective, they're they're really only, depending on what firm they're at, or if they're independent, or what have you, they really only know what they know. I mean, some people do insurance, some people just do mutual funds and stocks and bonds, those types of things. It really takes an advisor or professional who understands the bigger picture, from, it's as cliche as it is from a holistic standpoint, right? Everybody uses that word, but it's really true. And unless you really incorporate all the things that are available out there to help someone with their situation, um, then you're going to find that not a lot of people know what a HECM is, or how a reverse works, or how that can play a part in a retirement strategy. Because it is a strategy. It's not just a product or a program, but it is a strategy that you can leverage. Because let's face it, home equity in America is one of the largest untapped areas when it comes to retirement planning. And unless you know how to tap into it, then you're not going to recommend it or advise on it, or even recommend it to your clients.
Right. And that's what I see in my practice is that the retirement assets are a portion, but the home equity is the largest portion and it's often ignored.
Mm-hmm.
Do you have any perspective on why we ignore that in just kind of as a society?
I think it's just a matter of perspective. People, I want to pay my house off. Okay, well, great. Why? Why do you want to pay your house off? Oh, well, because I don't want to have debt. Okay, well, is your house going to pay you an income in retirement? Possibly, if you talk to Christina and
And
you know how to do
Ryan,
it. But, but I think it's just a matter of perspective. They don't know how to tap into it. They don't know how to leverage it and have it work in their favor while they're still living in their home.
So let's talk about that. That's a really, really good answer. And you do have strategies. So would you kind of mind going over a couple of these strategies where you could use a reverse mortgage in conjunction with your retirement planning and how you do that in your practice for your clients?
Yeah, happy to. So there's really four key areas or strategies where a HECM can come into play. And the first one is when it comes to Social Security. People are talking about Social Security running out by 2030 or 2033. So in 10 years, there's going to be no more Social Security. I don't wholeheartedly believe that. I think there will be a reduction in Social Security benefits for people. Even people that are already receiving it will probably take a hit and get some sort of reduced benefit, which, wrap your head around that. People are barely surviving on Social Security as it is. Now you're going to get a pay cut, basically. But as it stands right now, you can delay taking your Social Security up to 4 years. So full retirement age right now is 66 or 67. Things keep moving. Required minimum distribution age has just moved up again to 73 now, and they're talking about it going to 75. But the point is if you can delay taking that Social Security, the U.S. government will guarantee you a 7 to 8% increase in your benefit per year for 4 years. So there is no investment vehicle in the marketplace right now that will guarantee you an 8% bump in income for 4 years. So that's a 32% increase, right? If you extend it. But the point is you can leverage your home equity through a HECM or reverse mortgage to bridge that income gap. So you can delay. So now you're receiving a tax-free distribution from your home as a form of income to delay taking that Social Security benefit so you can increase your benefit payout, basically.
So I love
So,
that. I think in your
mhm.
practice, you probably hear this misconception. I've heard it before, and I'd love for you to kind of dispel it. I've heard people say, well, I'm 62. I want to start getting payments now. Or is it 66 maybe? I want to start getting payments now because that's more payments for a longer time, but it's at a lower rate. So
Mhm.
overall, if you die at the same point in time, let's say somebody passes away at age 100,
Mhm.
um, do you actually get more if you wait and the percentages go up?
Um, well, nobody knows the end date, right?
That's
But
true.
I think there's a couple factors. Your family history, your medical history, your own personal health. I mean, if you're in poor health, it might make sense to start taking it now or early at a reduced benefit. Um, I typically, and then their financial situation as well, right? Have they saved money? Have they grown assets? Do they have income producing assets for their retirement? Um, those all play a factor, but for me, people are living longer also, right? So I mean, geez, people could be living well beyond 100 in over the coming years, and I would want as much income as I could possibly get. So if there was a way to delay taking Social Security while maintaining my lifestyle and income, I'm all for it.
Yeah, that's a great point. I think I saw a study one time that said if you die at the same point in time, if you delay and you have a higher payment, you end up actually getting more overall. But that's a really great point. If somebody is in ailing health or does not expect to live very long, then maybe it might make sense.
Yeah.
Let me flesh that out a little. The reverse mortgage can make monthly payments to the person, let's say from age 62 till 70 or 73, whenever that Social Security is not RMD. So
Mm-hmm.
yeah, 70. Uh, then that can bridge the gap and then stop the payments so that you preserve the rest of the equity in your house. You're not taking it all.
Right.
That's a great strategy. Okay, so I know you have more than one. what's
Yeah. Well,
what's another cool
I got three
strategy?
more here.
Yeah, let's
Um,
talk about them.
yeah. Second is doing an efficient Roth conversion, right?
Ooh, okay.
So
Tell us
now
more.
we're talking about shifting or repositioning your retirement assets. And it's not a matter of if you pay tax, it's when, right? So if you've been putting your money into traditional IRA, SEP IRA, traditional 401k, simple IRAs, they're all in the same sort of tax category, which is taxed later or tax deferred, we call it. So if you're deferring that tax to the future, um, which is really unknown because the government can change the tax rates anytime they want, and in a rising tax environment, doesn't make sense to keep funneling your hard-earned dollars into an account that's going to be taxed at a higher rate probably than when you were working. So the strategy there is to shift forever tax, basically shifting your money from forever taxed via an IRA to never taxed into a Roth IRA systematically, but doing it as efficiently as possible. And that's where the reverse mortgage or HECM can step in and use your home equity to pay the tax bill upon that conversion.
That's how I was thinking. I'm like, how does the HECM play into that? So
Yeah,
you use the home equity to pay the bill so that it converts.
that's right. And
Oh,
now
that's beautiful.
all the money that you've shifted to the Roth or the tax-free bucket, as we like to say, you pay the tax bill because the taxes are owed. You pay the tax bill out of your home equity with a tax-free loan from your house.
And as you're saying, taxes are going up. So that sounds like a really smart strategy right now.
Yeah, yeah, absolutely. And again, it's about it's about ideal balance. Now, we won't get too deep into it, but basically, you don't want to shift all of your IRA money to the tax-free bucket, because if you understand the rules and understand what that ideal balance is, then you can actually take money out of your IRA tax-free. So that maybe for another time, but for now, it's that's what we recommend a lot to your clients is, when we do our due diligence and our fact finding, um, find out their age. And I mean, I'm talking about HECM in reverse all the time for that matter.
That's awesome. Some of these higher level strategies, I love that you know in depth. And anybody who wants to reach out to Ryan for your own retirement, please do. We've got a link in the comments to do that. All right, Ryan, let's keep going. What
Yeah.
are some of the other strategies you
So
like?
number three is just paying off your forward mortgage, right? I mean, people don't want to have a big mortgage payment in their retirement, so you can use a HECM to pay that off. Um, on the flip side of that is you can actually do a reverse for purchase if I'm correct, right,
Oh yeah,
Christina?
you got it.
Yeah. Yeah. So reverse for purchase. Now that is, I think, probably one of my favorite strategies for clients, because you think about it, people are downsizing, right? They're going into retirement. They're moving to somewhere warm, probably. Like my parents are a perfect example. They left Seattle and moved to Arizona about 3 weeks after they retired. Just sold the house, up, gone. See you later. Yeah. And
Wow, that's great.
but you know, typically there's a lot of equity that's been built up over the years in the family home, right?
Hmm.
So you sell your house. Well, what's the goal? Well, you're going to move and you're going to pay cash for your new house, probably for less money if you're moving to a different area or, a smaller residence or something like that. But, retirement is about income and liquidity, right? If you take, just as an example, right? Let's say you net $1 million out of the home sale, right? The mortgage is paid off. You net $1 million. You deduct 500,000 for both spouses, right? 250 each for capital gains purposes. You pay the capital gains tax on the 500, depending on what state you're in. That could vary. But you're left with some money. Let's say it's 750,000, right? So what do? You move and you go and you purchase a house for $500,000. You pay cash for it. Well, now your cash is tied up in your house. That's not going to pay you an income stream. And now your liquidity that's left is only 250,000. Why not, for retirement strategic purposes, you leverage a reverse mortgage for purchase? And I think the difference is upon your age, right? On how much down payment you have to put down. But
It's a
let's call
factor
it
of
half,
three.
right?
Yeah, it's a little less than half right now because interest rates are up.
Mhm.
But when interest rates are down, it's closer to half. I'd say probably 40-30%, depending on age. The
Oh,
older you
okay.
are, the more you qualify for.
Right. Okay. So you put, this, let's call it half for math, right?
Yeah.
So now you've paid 250,000 for a house. You still don't have a mortgage payment, but your liquidity is now 500,000 instead of 250 that you can use for whatever. You can put it into some sort of program that will pay you an income stream for the rest of your life. You can maybe get some long-term care planning, long-term care strategies in place, because that's a big one to that hits retirees, and really just it's the number one cause of bankruptcy for retirees is long-term care, believe it or not. Anyway,
Wow, I hadn't heard that before. The number
and
one
so
cause of bankruptcy. That's horrible.
yeah, medical costs that long-term care. But why not have the same thing in place where you don't have a mortgage payment, but you're not leveraging all of your liquidity to do it? So that's the third one, and I really like that, because that can free up and produce a lot of different options for people. Maybe they want to go on a trip around the world and take their family. Well, that costs money, and if you have the liquidity to do it, great. You know. Um,
Yeah.
so yeah, so I love that one, the reverse for purchase, when it comes to a planning concept.
Yeah, I had a client whose children were really pushing for the reverse for purchase. She lived in a big property and it was far away. She was a widower or a widow. And
Hmm.
her kids said, "Hey, sell the house and downsize and come down." And so the numbers were similar to what you're talking about. She netted 900,000. She
Hmm.
wanted to buy a condo near the kids for 600,000.
Hmm.
And in her head, she goes, "No, I'm just going to pay cash." And her kids are going, "But you're young." She was only like 67 and in really good health. And so they were saying, "You're young. Like, just talk to Christina." And she was against it, against it, against it. When she
Hmm.
finally understood how everything worked, she moved forward. She was really excited. And through the conversation, we kept saying, I worked with her kids and another loan officer, and she kept saying, "Well, I don't have retirement. All I have is the house." And we're like, "Yeah, but the numbers were 900,000. She was paying 600,000 for the condo. The reverse was covering about 300,000 at that point in time at her age."
Hmm.
So exactly what you're talking about. Her
That's a
retirement went
retirement.
from, right, it went from zero. She had
Yeah.
nothing but the house
Hmm.
to $600,000. And we kept saying, "You're gonna have to find an advisor." And she's like, "Why? I don't have any retirement savings." And we're like, "Yeah, but we're creating you one through this process."
Hmm.
Yeah,
Yeah,
that
that
is
is just
beautiful.
what a perfect scenario. Yeah, absolutely. There's so many great things you can do from that. Once you get to that point, there's a lot of great things that you can do to help set somebody up for the rest of their life.
Yeah.
Yeah.
Yeah, it's so powerful. All right, so I personally love that one too. I'm so glad you brought that up.
Yeah,
I call it the
absolutely.
retirement maker. She
You're
went from
right.
no retirement account to 600,000 and no mortgage payment, which was the whole goal. She just
Right.
didn't want a mortgage payment. All
Mhm.
right, so what's your fourth strategy?
Yeah, great. Yeah, the fourth one is probably one that not a lot of people understand or even have heard of, but it's using a reverse or HECM to mitigate the sequence of returns risk in retirement.
Okay,
Okay.
in English for our audience, what does that mean?
So yeah, so in English, sequence of returns risk is when you're retired, you need income, right? So you start taking income out of, say, your IRA, right? So let's say you take $50,000 per year to live on out of your IRA, 50,000 every year, 50,000, 50,000. Well, as we all know, the volatility in the stock market that's happening right now, up and down and down and down and up and down and down. Well, when you take that distribution, the sequence of returns risk is when the market is also in a decline. So now it's almost like you're double dipping into your IRA. You borrow 50,000, but then maybe you lose 20,000 on top of that because of the stock market. So now you're down 70 plus the taxes, right? So sequence of returns risk, well, let's say that you could borrow money from your home equity tax free to cover or to bridge the income that you need to borrow from your IRA. So now you're not really taking as big of a hit when the stock market goes down, um, and your IRA is depleting even faster, right? So it's
So
basically a way to supplement your income that you would normally take from your IRA, but you're borrowing it, you're taking it from your home.
this is what I'm hearing. So it sounds like every advisor would say during a down market, ideally, you're not taking funds out. Is that accurate?
Yeah, absolutely.
Okay, and
But
one way to do
you're
that is use the reverse. During
that's
the
right.
down markets, you don't take funds out. Instead, you take the funds from the reverse.
Hmm.
And then when the
Or you
market's
just
up, oh, sorry,
right.
go
Then
ahead.
you yeah. Oh yeah. So I was just gonna say, except in an RMD situation, right? If you're over 73, you must take your RMD, but you just take the minimum amount that you're required to take and you leverage the rest from your home equity
Ah, okay.
as sort of a supplement, right?
Got it.
Because
Got it.
you got to have income to live on in retirement. You can't just say, "Oh, I'm not taking any this year."
Right.
Well, you're going to live on $1,500 a month from your Social Security, or everybody's different, um, but yeah, it's just a way to supplement.
Oh, that's beautiful. Yeah, so
Hmm.
take the least hit you possibly can, and the way you can do that is by using the reverse mortgage funds during those years.
Absolutely, absolutely, and
That's
it's
so
tax
smart.
free,
Right?
right? Because it's a loan, it's tax free. But yeah, but like you said, to your point, when the stock market goes back up, you can turn off the reverse, borrowing from your home equity and continue on with your IRA distributions. So
Right.
it's just a leverage play, and you just have to have the right advisor that knows how to help you do that and to see it, and the right mortgage consultant and professional that can help you put that together. And it's really about having a team in place.
Yeah, and somebody like you and I could work together because so few people understand that you can start and stop monthly payments within the reverse mortgage. Not the fixed rate, but if you do an adjustable rate, which like 95% of all reverse mortgages are adjustable rate, you can literally say, "Hey, I want monthly payments for this number of years." At any point in time, you can call and say, "Hey, I don't want monthly payments anymore, make those stop," and continue to grow that line of credit instead. Or they could do it differently. Line of credit is all they have set up. So they just draw in larger chunks, 2 or 3 times a year, and then live off of that money. But the flexibility of this program to be able to say, okay, we can do monthly payments and we can stop those. We can turn it back into a line of credit. You can do a big chunk of cash now if you need to. It just makes it so flexible to work with somebody like you to be able to benefit from all of these strategies.
100% agree. 100% agree. That's great. Yeah, I've been very fortunate to be a part of a team and a company that does think outside the box and does put resources and energy into learning about these types of programs so that we can help our clients more.
I
Because
was really impressed the first time we talked. I think we met online and I was seeing your comments. I'm like, wait, this guy really knows what he's talking about. And initially I was like, is he a reverse mortgage person? No, you are totally right. Like so many financial planners, their companies, even up till 2011, there was a law in the book saying, hey, you can't talk about reverse mortgages. Why? I don't know. But that law went away, and so many firms don't know that. And so your firm being so forward thinking, I think, is so helpful for just the general population, all the way up to millionaires. We have reverse mortgages that go up to $10 million, like in
Wow.
value. And we have people who do that because it's not that they need a reverse mortgage. It's what you're talking about. It is a smart strategy done
Hmm.
well.
Yeah, people in that situation with those types of assets, they understand leverage. Yeah,
Yeah.
I mean that's really the difference right there, is just they understand leverage, and they're
Yeah.
not, are they open minded? Yes. Are they, skeptical? Probably, but they're gonna get the right type of advice and help and make a decision for themselves that helps them in the best possible way. And I mean, why not? I mean, if you can leverage your home equity and build assets outside of that are income producing, whether that's through real estate or, other financial products or tools that are out there, I mean, why not?
I love that you bring up the skepticism because I see that all day. You probably do too. And I
Hmm.
actually like those clients because they are looking to understand. They're
Yeah.
skeptical. They're not afraid. They're not too afraid to talk about it. They want to know their options. And frankly, we've all seen something in the past about reverse mortgages maybe not serving somebody in the right way. Sometimes that was the borrower's actions, sometimes it wasn't. But the
Mm.
reverse mortgage program has had so many protections built in. It's FHA insured. That's a government program
Mm.
at this point. Not
Right.
program, but insurance at least.
Mm.
Uh, and so all these protections built in over time make today's reverse mortgage awesome. Will I say, reverse mortgage 20 years ago, it didn't work the same. I wasn't in the industry at that time in reverse mortgages. I was doing regular mortgages, but it didn't work the same. And so for people to still have that fear to even understand, to just get their numbers, get a quote, see how it looks, I think people like you are opening that door to say, hey, just look at it. And if it's a fit, look at what we can do with it.
Hmm. Yeah. I'm like I said, we talk about it all the time because it is a great planning tool and can be if it's done the right way and have the right professional to help put that in place.
Yeah, somebody like you,
Correct me
somebody like
if I'm
me.
wrong, isn't it a non-recourse loan as well?
Yes, yes, it is.
It's
How,
that's huge.
how does that strike you? Some of our audience isn't going to know what that means.
Um, well, if the house goes under, you're not on the hook for it, right?
Yeah, that
Yeah,
FHA insurance picks up the difference.
yeah, and it would have to go way, way down since you're putting basically half down or whatever the percentages are now. But I mean, you got a nice buffer there. But yeah, that's that would help people sleep at night, I would imagine.
It absolutely does for the people who stick around to understand, because there's really only two situations that would ever be necessary, and it's the catastrophic, right? What
Mm,
happens if I pass away during like 2008 and my market value just tanks and maybe this mortgage balance is higher than my market value? Are my heirs going to be stiffed for that? Are they going to use the rest of my estate to pay that bill? No, they
mm,
only look to the property. It doesn't even show up on credit reports. That
mm.
it
Wow.
is so fascinating to me. And that's exactly what you're talking about. So in the purchase, in that client example I had, she pulled 600,000 out. What if she had paid 600,000 and passed away at a time when her house was only worth 400,000?
Mm,
There's
that,
200,000 gone instantly.
yep, yep.
And
That's
now
that's
people don't think about that.
no kidding. That's a great point. That is a great point.
Yeah,
I'm gonna
it's a
put
good
that in the
estate planning.
mental log here.
Yeah. Yeah, because then it's just the house. And a lot of the time, the heirs don't actually want the home itself. The heirs want the rest of the equity. And
Mm,
unless the catastrophic happens, or you live in a market where there's no appreciation or declining appreciation, and or you live forever. Well, if you're the guy or gal who lives forever, my gosh, you made out. You didn't have to get money from other sources, even though
mm,
your home's value was lower. That reverse mortgage continues on. It doesn't matter if the house is underwater, if you're still living, as long as you're in it, primary residence, paying taxes and insurance, any HOA. Um, there's one I'm forgetting right now. Maintaining it. You got to maintain the home. You're still the owner
oh,
on title.
man. Yeah, right, right.
Since it's the collateralized property for that. As
Mm,
long as you're doing those things, doesn't matter what the value does. Uh,
mm,
it is just incredible to me that this isn't a more known thing. And people like you, people like me, we're trying to get the word out there, saying, "Hey, just take a look. It's a financial tool."
mm-hmm.
So
Yeah,
on
that's great.
that note, before we started going, you were saying you had some experience with this. So can you tell our audience, some of the stories that you've seen, some of the ways that this has changed people's lives?
Um, yeah, so it was actually on a reverse for purchase scenario, and sort of the one that we were talking about before is it freed up several $100,000 of liquidity that they were able to have get to work for them. Right? They did a program that paid them a guaranteed income stream for the rest of their life. Um, they were able to obtain some long-term care coverage as well, and the husband actually ended up needing long-term care, and the the program that we were able to put in place was took over and paid the bill 100%.
Wow. What an amazing piece of leverage. So you pulled some of the equity to pay for long-term care, which the leverage, right? It's pennies on the
Hmm.
dollar when they use it like that. So
Right.
overall, that just protected their entire estate, I'd imagine.
Exactly right. For pennies on the dollar.
Right, right.
Yeah.
And it takes
Hmm.
somebody like you to be able to say, hey, here's how we can leverage and stack this. And of
Hmm.
course, you never tie these things together saying you have to do it. But if there's an opportunity to create this leverage and put them in a better situation, and now
Hmm.
I've seen people who just won't medically qualify for long term care. And in that case, it's like, well, where else can we get funds?
Yeah.
And reverse can provide for that too.
If you don't have it, it's coming out of your retirement. And if you don't have that, then you're going on Medicaid, which the government is trying to mitigate, if you will,
Well,
not
and I'm
eliminate, but they want. I mean, it's a huge burden on the budget for the government. It's massive. Now you're seeing states, well, like Washington, where I live, they just implemented a long-term care tax for W-2 employees.
really,
Yep, it's coming to California, and pretty. I think they're next, and there's about 8 or 9 other states that are going to be following suit. So if you do not have a private long-term care plan in place for yourself, and you're a W-2 employee, you're going to get an extra payroll tax that's going to not cover, but help. We
I
won't
think
get
you
into the
told me the
details, but
numbers one time. The numbers were kind of laughable,
it
right?
is
Like it's
it was
not really.
it is appalling the amount of tax that people will pay over their lifetime for the amount of benefit that they'll receive, and it's you know, in hindsight, it's a good idea because people should have some responsibility and take care of themselves and not rely on the government. But it's not even remotely close to what people will need to act if they actually need long term care.
Well, and it's so funny. People are so uneducated about, in my opinion, long-term care and
Hmm.
reverse mortgages, these two things. And they get to a life event where they need care and oh, Medicare will cover that. And I've talked to people whose parents have been on the Medicare plan for this, and the level of care they were saying don't ever rely on. Like, you don't want your parents, your grandparents in the system. You don't want to take advantage of it. It's not worth it for their health, their well-being, their livelihood, and your family watching, the I don't know if you've heard some of these stories, but some of the facilities, I had a loan officer who was almost in tears telling me about his process with his mom.
Mm.
And he had no idea. She had no idea. She just thought, well, Medicare will cover me. And it did. I mean, it kind of
Mm.
covered the finances, but her standard of living and her decline sounded like it could have been avoided if they'd had their own
Mm.
private thing in place.
Yeah, yeah. Medicare will only cover so much, hospital bills. But if you need, like you break a hip, fall down and break a hip, and you're immobile for 6 to 8 months, you know, Medicare is not going to cover somebody coming to your house to help take care of you, or you know, having you rely on your relatives to be there 24/7 to help take care of you. Medicare doesn't cover that stuff. So that's where long-term care can step in, and and there's so many great programs out there. But maybe another time we can dive into that. But
I'd
um,
love to have you back. I mean, this is
yeah,
great. All the
anytime.
strategies you got, all the insight and wealth of knowledge. Thank you for sharing it with us today.
Of course, yeah, happy to. Yeah, if we can help, then I'm all for it.
All right. Is there any other topic you want to go over before we kind of close this up today?
I Not really. I mean, I'm just here to answer questions and offer whatever sort of knowledge that I have. So
Very cool. And you've shared a wealth of knowledge. Thank you so much. So I
absolutely.
like to end by asking one question.
Okay.
If you could change the face of American retirement, how would you change that?
Whew, that's a good question. Change the face of retirement. Well, I would say that saving money is a habit, right? If you think about it, if you just get used to saving money and putting it away, and paying yourself first, as they say, I think that's an area that it would start, and then being financially educated would be, I think, one in the tied for first. Because understanding how money works, understanding what you can do to help save and grow and build wealth from all the different programs that are out there, from like real estate or investments or insurance or whatever. Just understanding and being educated on those topics would be a huge start to changing the face of retirement. And then getting in the habit of saving money and not just spending it on depreciating assets, like cars. And I mean, it's crazy, people's car payment, and they don't even own a home, or whatever the situation is. It's I think there's just the perception of money, and people's lifestyle is seems to be way more of a priority than saving for their future selves. Nobody ever said, "Thank God I didn't save any money," or
I
so
haven't heard that one either myself, not yet.
yeah. So I think those are probably the two that stick out in my mind, just off the cuff here.
I would love to see those changes too. Whew, our
Yeah,
country would be very different.
absolutely.
All right, Ryan. Well, if somebody wants to get in touch with you, how can they get in touch with you? We have a
Yeah,
link, but just,
yeah, we'll leave a link, but I'm on all the social media platforms: LinkedIn, so Facebook, Instagram. My website is wealthwave.com/Ryan Bishop. You can get me there with all my contact info, or drop me an email through my website.
awesome. Awesome. Well, thank you so much, Ryan. I think you have shared a wealth of knowledge, and I look forward to having you back.
All right, I'll look forward to it.
All right. Thank you. Bye,
Thanks.
everybody.